Thank you all for all joining today. I'm hoping the morning sessions have been good, and now we'll have an afternoon session, which I think will just be as good as the first part. To start things off, ladies and gentlemen, would you please rise for the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you very much. You may now be seated at this time. We'd like everyone to take a moment to bow our heads and reflect ourselves in silence. Bless this meeting today, all those present, as well as the lives of those we encounter afterward. Thank you for choosing to own, operate, and work in the companies of our choosing. Watch over our troops as they fight our freedom and the freedom of others. Thank you for this food and the hands that prepared it and served it. Amen. Okay, please remain seated wherever you are on this glorious day as we now welcome to the stage Ed Ryland, CEO of Arvo Realty and Chair of the Board of Directors for the Houston West Chamber of Commerce. Take it away, Ed.
Well, good morning and hello, everybody. So nice to see you guys, and thank you guys for coming out and participating. I think our first virtual Outlook program, and I tell you, COVID and the new way of doing business has challenged us to be more innovative and creative, and we never back down from a challenge. So we thank you so much for that. So how about this session this morning? I thank everybody for being here, and I thank everybody for participating. I want to say, first of all, good afternoon, ladies and gentlemen, on behalf of the Houston West Chamber of Commerce. I would like to welcome you to the West Houston Outlook Conference and this virtual business expo presented by Amerant Bank. So I just want to give Amerant and our other sponsors a round of applause. I know they may not see us, but I definitely want to thank them for their support today and their involvement with the Chamber. And from wherever you are at this time, we thank you for participating. I hope that you are enjoying the event so far and making plenty of new connections to HUVA, which is our virtual event platform sponsored by MD Anderson Center. As some of you may know, the Houston West Chamber represents over 800 businesses in West Houston with more than 45,000 employees. So we are impacting families all across the West Houston area. Well, we as a chamber are working hard to secure a positive future for West Houstonians. And West Houston offers some of the most desirable residential and commercial addresses in the greater Houston area. But we are home to the world's largest energy companies and the best hospitals. We boast numerous consulates, international cuisine, and many other prominent businesses and organizations. West Houstonians do not have to travel very far to get to the medical center for world-class care. We have everything you need in our own backyard, including Texas Children's, Memorial Hermann, Memorial City Medical Center, MD Anderson Cancer Center, and HCA, Houston Healthcare. And don't forget our nearby educational institution, which include Rice, University of Houston, Houston Baptist, and the Houston Community College, just to name a few. The Chamber represents businesses from the Greenway Plaza through the Energy Corridor. And if you are not a member now, we really encourage you, invite you to check us out and to become a part of our movement to secure a more positive future for West Houston. So you can find the virtual expo booth on HUVA, where Karina, who you heard from earlier, would love to get in touch with you and get to know more about your business so that we can understand how we can add value to your organization as well. Before we introduce our MC, I want to introduce and recognize Carrie Werner, who has been appointed, as some of you know, as our new president of Houston West Chamber. We're so excited about Carrie and her leadership of the organization. And so I want Carrie, if you can, please take a stand or take a wave in this virtual environment. So our folks can see you and say hello. Carrie and her staff are working extremely hard to make sure that our business not only survive, but thrive in this very challenging economic environment. So we want to thank Carrie, and it's been a pleasure being a part of that team. So now it's my pleasure to invite our MC, anchor and business reporter for ABC 13 News, Mr. Tom Abrams, to the podium.
I hope everyone's doing well, and everyone and their families are healthy right now, and overcoming all the challenges of the last year. Certainly appreciate all of you being with us, and I'm pleased to be here again serving as your MC, albeit virtual. This year, we'll be dividing the virtual conference today into two distinct segments. There'll be the presentation of the West Houston Regional Economic Outlook Report with an emphasis on West Houston, as always, presented to you by Jesse Thompson, Senior Business Economist at the Houston branch of the Federal Reserve Bank of Dallas, followed by a panel discussion highlighting industry leaders from the West Houston area. Now, we have some exceptional community leaders with us today, including the current and former West Chamber of Commerce Board of Directors, Advisory Council, Platinum Partners, and Chairman's Circle members. We thank all of them for their work to help businesses in West Houston. Now, normally I'd ask you all to stand, but I don't know how effective that would be today. As we move on, I do want to turn our attention to our sponsors as well. They've made today possible. An event of this magnitude, even for a virtual event, just wouldn't be possible without the support of the generous sponsors who always come through for the West Chamber of Commerce. At this time, let's take a closer look at our event partners. They include Amerant Bank, Texas Children's Hospital West Campus, MD Anderson Cancer Center, Memorial Hermann Memorial City Medical Center, HCC Goldman Sachs, 10,000 Small Business, Abbey Residential, True Color Graphics and Fast Signs, and Houston Community College. Thank you to all of those sponsors. We certainly appreciate all of the generosity that you give to this group each and every year. And at this time, I'd like to introduce to you the driving force behind today's event, Misty Starks, the president of 3B Resources Group Public Relations. She's the dedicated leader of the West Houston Outlook Committee. Welcome back, Misty.
Thank you, Tom. This event has been over a year in the making and would not be a success without the help of a very dedicated group of volunteers who have a passion for West Houston. I would like to thank each of our committee members, so please be sure to reach out to them on Hoover and thank them for their tremendous amount of work it took to put this event together. Richard Nevins, independent consultant, Bo Lazar of Amerant Bank, Dick Helmy of True Color Graphics and Fast Signs, who's also our past chair of this committee, Ryan Jones, CPA, Pierre Luigi Stella and Sheila Go of Network Box USA. And it's with a huge, huge amount of gratitude that I want to thank the Chamber's event coordinator, Devin Wagner, and our marketing coordinator, Monica Viveros, for their incredible work in putting this event together. We cannot thank them enough. They have done an incredible job, especially pivoting and making this a virtual event, which is usually in person. And of course, we want to thank our chamber leader again, President Carrie Warner. We thank you so, so much for your leadership. I would especially like to thank Amerant Bank for their generous support of today's program. Actually, Amerant Bank has been the lead sponsor of this event since it began 6 years ago. So we give a heartfelt thank you to them. We started the West Houston Outlook. Was formerly known as the West Houston Economic Development Summit. It started in 2014 when the energy industry had started into one of the deepest slumps we'd seen in a long time. And then now with the impact of Hurricane Harvey largely behind us, we've all faced something no one alive right now has ever seen of this magnitude, which is obviously the COVID-19 pandemic. So there's a lot to consider as we look toward 2021 here on the west side of Houston. And to get some valuable insights this year, the Houston West Chamber of Commerce collaborated with Jesse Thompson, senior business economist at the Houston branch of the Federal Reserve Bank of Dallas, to provide an update on the outlook for Houston and to dive into some of the impacts on West Houston. In addition, we wanted to hear from executives representing other key industries in West Houston to find out their outlook for the upcoming year. So following Mr. Thompson's remarks, Tom Abrams will lead the panel discussion of these key leaders. So first, I have the distinct pleasure of introducing our featured speaker, Jesse Thompson. He joined the bank in 2010, and he performs research and analysis on issues affecting the Houston and Gulf Coast economies. In particular, he studies issues surrounding areas of hydrocarbon industries. He also collects information for the Dallas Federal Bank's Beige Book summary of current economic conditions. He's the author of the monthly Energy Indicators, the Houston Economic Indicators, and contributes to the quarterly publication Southwest Economy. Thompson earned a master's degree in economics with emphasis on empirical microeconomics and a bachelor's degree in philosophy and economics from the University of Houston. I am honored to present Jesse Thompson.
Thank you very much for that introduction. It's great to be able to see people, even if it's virtual. Looking forward to this every year. Of course, I wish it wasn't during happier times, but I'm happy to see everybody. And we've got some interesting stuff to get through here in the presentation. I was literally reassembling this as the call came for me to sign on because of a glitch in my computer. I nearly deleted all the slides that I had for y'all today, but I got almost all of them together. So I'm going to talk about, well, actually, before I get into what I'm going to talk about, as always, I have to give you the disclaimer and that my opinions are mine and mine alone and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, or anyone else associated with the Federal Reserve Bank in any way, shape, or form. We are also in the middle of blackout. What that means is that, you know, we're coming up on the FOMC meeting here next week, the January FOMC. Where we set monetary policy for the country. And so as a result of the proximity to that event, there are certain topics that I'm really going to have to avoid answering any questions on, and I'm not going to be able to talk about. But there's a lot of information that's great that we've got that was public prior to blackout that I'm going to share. But I really want to get to the questions to the Q&A period, because that's where things will get the most zoned in for y'all. So let me share my screen. So here's the presentation. So here's starting off with the economic backdrop. And this is sort of some of the key takeaways, some of the key high altitude takeaways that you can take from this. So first off, we all know what happened last year, COVID-19 containment. So our response to the virus, not only the toll that the virus took itself, decimated the growth consumption, the growth outlook. And the global second wave that we appear to be in right now is definitely muting the outlook for the first half of 2021, is what that should say. First half of 2021. So if forecast expectations that published through the earlier part of this month had definitely, some of the steam had been taken out of the stride there that the recovery was on as a result of the surging pandemic, particularly for developed nations like Europe and the United States, and certainly Texas. We're seeing it here too. There's a high degree of uncertainty in any of the projections going forward, still because of the virus. How bad is it going to get? Are we going to what extent do we lock down or go back into lockdown? Do we have another contractionary period here in the next few weeks or months? Well, how quickly do vaccines roll out, and what effect do they have on the willingness of people to go out and engage in regular economic activity? So there's a high degree of uncertainty in all of these things, but I'm going to try to talk through what that means for the outlook when we get to the Q&A session in the end. Overall, if you're looking at world GDP growth, we were down about 4.2% last year, according to the consensus economics and World Bank forecasts. And we're going to be up about 4.8, maybe 4%. There's varying assumptions there. Depending on whose forecast you're looking at, they may not have yet rolled in the effects of just the last few weeks on the global outlook. When we look at, say, similarly, we look at the blue chip consensus forecasts, and I like consensus forecasts because generally speaking, averaging together a lot of different forecasters is going to give you a better view than any individual forecaster. And when you look at blue chip and the average of several different forecasters, US GDP, because we're still forecasting what just happened. So fourth quarter of 2020 versus fourth quarter 2021, down about 2.5% on a year-over-year basis. But, and bear in mind, there's a bit of a slowdown in the first half of 2021 between where we were at the end of 2020 and the end of 2021, where we were in December versus where we're going to be at the end of this year. We're expecting the economy to grow a fairly robust, 3.9%. Now there's a range around that. There's an uncertainty there because what do you expect what's going to happen with the virus? But we are still expecting some robust growth in GDP. And if you look at, say, December, and you can see this was published in the Houston Economic Indicators on the DallasFed.org just a week ago. If you look at the Survey of Professional Forecasters in December, was forecasting U.S. job growth of about 3.6% December over the course of 2021. Now, bring that down to Houston. So what does this economic backdrop mean for Houston? Well, with energy in neutral, in terms of what it means for the energy, for job growth in Houston, and we'll get into more detail why I'm saying energy in neutral. Houston is unlikely to significantly outperform national job growth. Historically, the big differentiator between us in Houston and the rest of the state or even the rest of the country is the oil and gas sector. And with energy in neutral this year, we are not likely to outperform the United States. Historically, we perform about the same as the rest of the country, maybe a little bit faster when oil prices are just kind of at neutral. They're kind of at a medium territory, not really growing the rig count, not really declining. Without energy giving us a boost or dragging us down, we tend to perform about as well, maybe slightly better than the nation as a whole. So just a quick picture. You can, if you want to track out, we post all this data on our website. Here's where global GDP went last year. You can see that emerging economies here at the top, we're of course growing at a faster pace. They were actually technically one of the first to decline, but they declined a little bit less than everybody, and they've recovered. Part of the reason they declined a little bit less than everybody is because of the timing there, because China is such a big part of that equation, and they bottomed out earlier in the year in first quarter rather than in second quarter. But they declined and then they've bounced back some, and this is the data that we have. You can see the recovery was the bounce back in GDP was beginning the recovery, but we're still a long way from last year's levels, from 2019's levels. And if you extend forecasts out from a lot of these entities like the World Bank, it looks like, well, we're probably not going to get back to last year's level. We're probably not going to get back to 2019 levels, pre-pandemic levels of global output over the next 2 or 3 years. We're going to log robust growth, but we're not going to get back to where we were, or I should rephrase that. We're not going to get back to 2019 levels until probably 2022 for the most part. And we're not going to get back to where we would have been had we not had the pandemic for the next several years throughout the forecast horizon. It doesn't look like we're going to get a full bounce back like you would have expected had this been a normal recession. But when you look at higher frequency data, and this is going to bring it back to Houston again, when you look at these manufacturing indexes around the world, they are in point of fact bouncing back. Now you're seeing robust growth here on the far right-hand side of the chart. Anything above 50 is an expansion in these manufacturing surveys. Anything below 50 is a contraction in these manufacturing surveys. And so we are back to growth, but it's growth from a very low level of output. All right, so we're still not back to the same kind of output levels that we saw before. When you look at emerging economies, you can see China there. You can see that emerging economies bouncing back more quickly. Advanced economies, you can see there's the light blue line. The one that brings it back to Houston is this blue line. This is Houston export markets. Remember, what do we export in Houston? We export machine parts. trucks, equipment. We export plastic pellets, energy, raw materials. That's what we export from Houston to the world. And it goes into manufacturing supply chains around the world. And so when you look at that blue line, what you're looking at is what are the manufacturing, what's the manufacturing activity look like in those countries that Houston exports to? And it looks like they're doing relatively well. They're bouncing back. We're right in the middle of the pack. We're not doing quite as well as the rest of the developed world as far as our export partners, but we're not underperforming the emerging market. So we're doing better. We're right there in the middle pack, and things are growing, and that's positive for trade for Houston, and more importantly, that's positive for trade-related jobs in Houston, which includes a lot of manufacturing jobs. Now, looking at the United States specifically, we published this weekly economic index on our website, and it is a very good proxy for what we're going to find out in a quarter or two, what real year-over-year GDP growth in the United States is. And so right now it's, a little over a week ago it was about negative 2.5. And right now it's about negative 2.0. So we're down about 2% year over year. That's on par with what we were with the forecast I was telling you about earlier. Down about 2.5% in the fourth quarter of last year on a year-over-year basis. And so the extent to which we're down year over year has really improved as we moved through the pandemic, and now we're looking at continued growth, probably muted in the first part of the year, maybe even a little bit of a contraction, who knows? But once you're looking at overall over where we are now versus where the consensus expects us to be at the end of the year, it's going to be another year of growth, of output growth. So let's talk about Texas in the pandemic. First off, from February to April, Texas did not drop as many jobs as the rest of the country. We didn't. Now, part of the reason for that, even though it felt like we should have, or we might have, was that one of our sectors, the energy sector, had actually already been shedding jobs for quite some time. And so they were coming into the pandemic relatively lean on the manufacturing, support services, everything. So we had already had a little bit of a slowdown, but also Texas, we just, we're a little bit more resilient just heading into it, just because of our industry mix. When you look at recovery, since then, our recovery hasn't been on pace with the rest of the country, but again, we didn't fall as far. And so maybe we shouldn't be expected to be recovering at the same pace because there just wasn't as much to snap back. But leisure and hospitality, in terms of thousands of jobs, has been the big where the big job recovery has come from. But if you look over here on the right-hand side, Texas oil and gas mining support services is just mounting losses. When you look at since April. So this is April through November. So this is April through November. December numbers dropped just this morning. So when we get to Houston, I've got that number for y'all. Unemployment rates spiked. They fell rapidly initially, and now they've kind of leveled off and they've slowed down in terms of its pace. This is expected to continue to improve over the course of the year. But as we move past this initial reopening phase, normal recessionary dynamics are taking hold. And just like if you look at, say, after the Great Recession or after 2004, where the unemployment rate slowly kind of drifted down, we think the improvement is going to be a much more gradual in unemployment and the unemployment rate, I should say, going forward. COVID-19. So increasing in Texas while economic data begins to weaken. So what you're looking at here, and to my mind, the thing that really seems to move the needle in terms of economic activity is the hospitalizations. The cases are still a little bit abstract for a lot of people, but when the hospitals tell you we're in overflow capacity, that's a pretty strong signal. Hospitalizations, you can see they've surged. We're now at a peak, highest level of hospitalizations that we were in. Cases are at a very high level. Deaths are unfortunately a very high level. And trends are that, with the way these things are lagged, this is likely going to, statewide at least, going to continue to increase over the coming weeks. But some signs that the hospitalization rate is slowing. that the new cases here have leveled off, and that these numbers will at least begin to level off and hopefully begin trending in a better direction, trending down here in the next couple of weeks. And that's really important, particularly when you look at this blue line. And I talk about this in more detail on the newsletter that I just published for Houston. Mobility and engagement index, it dipped and it recovered and it started falling again in June prior to the reimposition of lockdowns or the reduction in allowed capacity at bars and restaurants and whatnot, and before we shut down the bars. So people react to the virus. It's not just a story of government mandates. There's people reacting to what they're seeing out there. And then it recovered through the end of the year. And then as you look in the holidays, you can see a big drop off in mobility. That's really seasonal effects, holidays. But once you get past the holidays here, this last number, we're definitely not back to where we were in terms of mobility, in terms of people leaving their houses, going out into the economy and engaging in economic activity. We're not back to the same level that we were a few prior to the pandemic, prior to the holidays. And then when you look at the number of hourly employees working, and this is hourly employees mostly clocking in at small businesses citywide or metro-wide. And what you're seeing here is a definite decline post-holidays, and we're not seeing a return. Now, when we're looking at this data, it's a little hard to disentangle the virus from holiday effects and other just normal seasonal effects and weather. But it seems clear that the viral load on the region is weighing on this economic activity here in January. And you can see it kind of clearly here in restaurant reservations. They've dipped here as we've gotten into the new year. And you can see how Houston compares in the light blue here. We're kind of right in the middle, right on par with the state of Texas as a whole, but we're still doing better than the rest of the country, as we always like to point out in Texas, but the pace of improvement has definitely come off. Okay, local conditions. So this is indexed to December, I'm sorry, again, a chart that was remade, this label didn't get updated. This is indexed to December 2019. So December 2019, so how we are relative to this. So this is payroll jobs level in Houston. You can see the growth 2017, we're past Harvey, we're past the worst parts of the oil bust. We're back to growth in 2017, 18, and 19. The pandemic hits us. Houston bounces back relatively quickly, and then we slow down relative to the blue line here, which is the rest of Texas. Texas outside of Houston is doing relatively well and outpacing the United States and outpacing Houston overall. And that's largely driven by strength in the I-35 corridor. When you look at Houston payrolls, you're looking at the rest of the country, we had a steeper decline, had a bigger bounce back, but that pace of recovery has leveled off relative, on pace with Houston here through November, and then the December number, you see a little bit of a fall off for the United States. Where are we here in Houston on the recovery? We're at about 45% of our payrolls are back to about, have recovered about 45% of the pre-pandemic, of the job losses that were incurred during the pandemic. So 45% of those jobs have been added back. So we're still down quite a bit. We would have to grow, and this is as of this morning, as of data this morning, January release. So we've got data through December. Houston would have to grow 6.8% from this year, from December of 2020 to December of 2021, in order to get back to where we were in February of last year before the pandemic really hit us. That would mean that we would have to grow at nearly twice the pace of the expected job growth rate of the United States as a whole. And remember, with energy in neutral, expected to be in neutral, meaning it's no longer a drag on the region. The pain, the worst part of the oil bust, of the pandemic-induced oil bust here is behind us, but not really adding to job growth either this year. With energy in neutral, it's going to be really hard for Houston to outpace the nation as a whole. So we are not likely to get back to pre-pandemic job levels in Houston this year. It's maybe in sometime in 2022, depending on how things unfold. but certainly not this year. That's not to say we're not going to log significant job growth. I mean, I haven't finalized my forecast yet, but depending on the assumptions, anywhere from 2% to 4% seems like a reasonable number for Houston this year. I'm going to narrow that range here, hopefully, in the next few weeks as we get some data releases. But it certainly seems, but we're certainly going to log growth. We're certainly going to see improvement across sectors. But the pace is probably not going to be 6.8%. It's not going to be close to that. Which sectors of our economy grow is going to depend on the pandemic, because while a normal business cycle, we would think, it's the goods sector, it's energy, it's manufacturing, and to some extent the service sector, but it's mostly the goods sector that's soaking up the volatility, that's soaking up the cyclicality of a business cycle in Houston. This time, the pandemic, the rules for containing the pandemic are landing square on the shoulders of the service sector. And so how we respond to the pandemic and how things improve over the course of the year, knock on wood, that is going to determine the breakdown here and sort of where we ultimately fall. And I'm looking at the time here. I'm going to try to pick up the pace. Here you see initial claims kind of leveling off. Again, more evidence that Houston, after the pandemic, after the holidays, we're feeling something from the pandemic, from the viral surge here. Energy. All right, so West Houston, you guys are keenly watching this. So energy, and I'm getting panicked calls about what's going on here with the cancellation of what's happening in federal lands. We'll get to that, I think, in the Q&A session, but. The pandemic job losses or the oil bust job losses, typically once the price of oil bottoms, and the rig count typically follows the price of the price of oil with a lag of about 3 months. After the price of oil bottoms in a bust, with hindsight being 2020, because we never know what the bottom is until we can look back and say that was clearly a bottom, it takes about a year. Now, last time we did it in a little bit less than a year, but it takes about a year for the jobs to really bottom out. And when you look at these selected mining related jobs, which includes manufacturing in Houston, it's not just E&P companies and oil field services, but it's also a lot of manufacturing jobs in Houston. You see this tick up right here. I don't think that's real. I think that's going to get revised away. But you see, we're still kind of in this downward trend. You have a bit of a tick up, but then that's back to a downward trend. I think that tick up's going to that bump there is going to get revised away and smoothed out. And we're going to probably bottom out sometime here in the first quarter of 2021. The rig count's already up. Oil field activity, companies have already started completing a lot more wells. So the activity is up, but at a much lower level. And it seems unlikely, just like last time, it seemed unlikely that we would ever get back to this many jobs. It's going to take a while before we ever need to get back to this many jobs. The productivity just keeps growing in very real ways. And so we're just not going to need that many people, which has significant implications, of course, in Houston for what's going to happen to the office space, commercial real estate sector. But oil prices are up. Thank you very much, OPEC, for that Christmas gift. They are up to about $50. And so far, since relative to the first half of this month, that seems to be holding. WTI is back up at $50. That being said, bankruptcies have been severe. In terms of total number, it is nearly 2020 rivals 2016 for the total number of bankruptcies, but the bankruptcies last year were much bigger. On an inflation adjusted basis, we are looking at about a little over $90 million in bankruptcies versus 75. I think the million is not the right word, but the total dollar, I'm starting to get my units mixed up here, but the total dollar value of bankruptcies is larger than it was in 2016 on an inflation adjusted basis. So this was a big bust. And you'll notice if you look at this chart, the industry had a pre-existing condition here before it caught COVID. We were already seeing bankruptcies rise prior to the pandemic. So the industry was not in a good place heading into this as it was. But the pain does seem to be mostly behind us. Consolidation is still happening, and that is going to, again, put downward pressure, particularly on the need for white-collar jobs in office space in Houston. But the energy industry is still, there are still some bankruptcies in the works. There are still some layoffs that are in the pipeline. There is still consolidation ongoing, but the worst is behind us. All right, and we think that overall we're back. We're into neutral territory. The consensus, and this is an average of many different forecasters, the consensus here of forecasts for global oil consumption is that we're at about 94.5 million barrels a day globally in the fourth quarter, and that we're basically going to stay at that level flat roughly in the first quarter with a little bit of a pickup in the second quarter. But really, it's the back half of the year when we get past this wave of the virus, when as the vaccine rollout continues, as more immunity develops and people begin getting comfortable getting back out into the world and driving and traveling and doing things, we're going to see consumption really pick up in the back half of the year. But note, it's still not expecting global oil consumption to break 100 million barrels per day. Still not getting back to where we were prior to the pandemic in 2019 this year, probably sometime in 2022. Real estate. Single family housing is really doing well. It's the brightest, well, arguably the brightest spot in the outlook right now in Houston, or anywhere. Now, as someone who lives on the lower altitude side of the watershed, I'm not too keen on all that construction. I'm not necessarily thrilled about all the construction, but there is a lot of construction going on. And the biggest driver seems to be, number one, heading into this, we already had a supply constraint, meaning the supply of both existing and new homes was not keeping pace with demand. And of course, record low interest rates, with everyone rushing to refinance earlier in the year, and in many cases finding that the interest rates are low enough now to even refinance again. Low mortgage rates are absolutely helping the single family space, particularly larger suburban homes, detached homes, larger spaces, things like that. Multifamily permits for construction are still going on. It's a little bit volatile, but they have not fallen off, and they're pointing towards these are both pointing towards a healthy construction market in Houston in 2021, I should say. Home sales and median home prices, same story. Mortgage rates and tight supplies. The month's inventory of existing homes, I think citywide, is down to about 2.5. That's a citywide, means it's lower in some areas and higher in others. But we're down to about 2.5 months of inventory. Sales are high, prices are rising, supply is constrained. And again, a big part of that is mortgages and then demand for more space. Getting into the outlook here. The usefulness of these charts right now, because of the unusual features of the pandemic, is limited. But I will say this, they are still pointing towards an increase in economic activity over the course of the next 3 months. And the business cycle index here, that is our best indicator for local GDP growth. So think of this as a proxy for regional GDP growth. Definitely strong growth on a 3-month basis. So we're seeing improvement even through the end of the year in Houston. And this leading index is still seeing growth, not as fast as we were seeing before. Again, slowdown, but still implying positive growth over the next several months. The pandemic kind of throws that interpretation into some question, but we're tracking it anyways. When you look to other leading indicators like Texas leading index, the US leading index, again, improvement is ongoing. We're still improving. Things are still getting better, but not at quite the same pace that they were earlier in the recovery. Now, we have not gone public with our Dallas Fed regional forecast yet. But just to give you an idea, we're kind of coasting in statewide to a decline of about 5.3%. year over year. I think the numbers came out this morning of about 5.4. So we were pretty close for the decline year over year statewide. And so state of Texas overall is outperformed Houston. It's outperformed the nation as a whole. So year over year, Texas did not decline as far as the rest of the country, but Houston did decline about the same as the rest of the country, down about as we saw before, about 6.4%, 6.8%. 6.5%. Now the state and local jobs numbers, I'm going to warn you, particularly when we get to early March, are going to be revised, and the revisions may well be significant. Okay, so they may well be significant. But once those revisions get rolled in, we'll have a clearer picture of exactly what happened. But I think this story of a fast recovery, slowing down as the virus viral burden on the region increased, and taking the steam out of the first half of 2021 is the narrative that is going to dominate the forecast. Now, I want to go ahead and get on to questions because I know that there's going to be several with what time we've got remaining.
All right, so I'm going to guess that this is when we begin the panel discussion. Thank you, Jesse, for that very comprehensive and fascinating look into the future of our economy. I know that a lot of people could be maybe cautiously reassured by your forecast. We do have a copy of the economic report available on WHOVA when you go to the agenda tab and follow it down to the keynote presentation. Now, this is where we begin the second portion of the presentation, and we talk to some West Houston industry leaders. Our panelists each represent unique businesses that contribute not only to the West Houston economy, but the Houston region as a whole. Guests who are chiming in on WHOVA, I'm not sure if I'm pronouncing that right, maybe you're calling it HOVA. You can find our panelists' backgrounds and bios in the agenda as part of their profiles. So as I introduce you panelists, please unmute yourself and turn your cameras on. Our first panelist today is Frank Meckel, SVP, Regional Sales and Service Manager, Retail Banking, Texas. Our next panelist, Dr. Richard Ellers, Associate Vice President, Division of Houston Area Locations, the University of Texas MD Anderson Cancer Center. And if by any chance I mispronounce any of your names, please make sure to correct me when we get to you in the questions, and I apologize in advance if I do. Next up, we have CEO of Blue Lance, Umesh Verma. We'll cover important issues that technology and cybersecurity industries are facing today. And you already met our fourth panelist, Jesse Thompson, but we'd like to welcome him again to the panel. I know all of you will offer some great insight into the questions that we have prepared. Now, Jesse stated Houston will be entering 2021 with a somewhat slower economic growth outlook versus last year, but Texas and West Houston are still well positioned to continue to do well in our region and in the US. With Hurricane Harvey behind us, the energy industry back in cautionary mode with COVID-19 still in the picture, his report certainly offered a comprehensive look at how Houston and West Houston will be impacted economically. So let's get to some specific questions related to your industries and the forecast for 2020 and beyond. And I'll begin with Frank. Let's talk about banking and finance. First question is what the pandemic brought about an explosive shift of consumer engagement to all of the digital channels, with employees working remotely and customers turning to digital channels for their banking needs. How do you see financial services changing in 2021? Which aspects of what you did quickly to engage your customers and your employees is something you'll now carry forward regardless of the pandemic?
Okay, well, thank you very much. And thank you, Jesse, as well. Very interesting presentation. You know, it's interesting because what we have seen over the past few years has been a conversion, a transformation, as we refer to it, towards digitalization. And so I think if we look back at, at what we've been seeing happening with technology right off the bat, just something like depositing our checks with our phones, that's something that years ago we didn't have. And we couldn't have imagined that. And now it has sort of become the norm, right? And that speaks to a trend that we've had in the industry towards looking for ways of incorporating technology to make our processes more efficient. Now, I think that this situation, the pandemic, has clearly put us all to a test and made us hasten the implementation of a lot of these technologies. And it's tested us in ways that, some things aren't working quite as well maybe as we thought they would have. But it's something that I think has kind of validated the direction we were taking. Let's face it, the delivery of so many products and services nowadays have to be done and accomplished through digital means that banking had to be there. So I think that you're going to see many of these products taking root, and a lot of customers that might have been a little hesitant to embark on these paths really embrace them, because it is a way of remaining safer, staying at home, and using some of these tools that they have at hand. I think we will be seeing more tools developed and increase that. And you can see that in some of our new branches. For instance, our Katy branch, that's what we refer to as a transform branch. And the technology itself in the branch is significantly different than what we have in our more traditional branches. I hope I answered most of your question there.
Well, I'll open up that same question to anybody else who'd like to answer it, because I know that sort of this new digital economy is probably here to stay in just about every sector as businesses reimagine the way that they interact with their employees, conduct business on a daily basis with clients, and engage with the public. Anybody else care to comment on the impact they think that will have both short-term and long-term in West Houston and beyond? I'll take that as a no, and I'll move to the next question. So let's talk about healthcare, certainly on the forefront of everybody's mind in this past year. And let's maybe ask a question that may or may not be able to be answered, Dr. Ehlers, and that is, how do you see the vaccines rolling out in West Houston, and how that ultimately impacts people's ability to get back to business as it was, to the degree that we can, before COVID? I'm not sure if Dr. Ehlers is on.
Yeah, sorry, Tom, I was. Yeah, I think the from our perspective, the vaccines have really been rolling out. Probably the best term I could use to describe it. Really, it really is surprisingly large logistical challenge to be able to deploy these vaccines in a responsible way. But all healthcare institutions that are charged with doing it in the 6 main hubs that we have across the greater Houston area, specifically the ones in West Houston, they're really trying to do that in a safe, timely, efficient, equitable manner. And because it is a 2-shot injection, you really have to be cautious with how you do that, so that you can ensure that the people that get the first and get the second dose will come back and get supply. And there's also, the logistical challenges of being able to make sure that people don't jump the line in order to get it. But I think what we're seeing is really good deployment so far. Obviously, it can't come fast enough for any of us, but we're going to continue to see that build in the coming weeks and months of this year. And I think as it builds, you're going to continue to see more and more availability of it.
And do you see the vaccine being, we've heard it described many times as being, the light at the end of the tunnel. Is it still a pretty long tunnel till we get to the end?
Well, I think that remains to be seen yet, really. And that the main reason for that is to try and determine what the long-term durability of the immune response is going to be to the vaccine. It was developed quite quickly, fantastic for all of us, but the downside is not term vaccine and how long that immune response is going to last. So it's unclear if it's going to be something like a flu shot that we need to get every year, or if it will be more like a tetanus vaccine that you would get every 10 years. It's probably somewhere in between, but I do think that it does offer us hope to be able to the prevalence of it. And certainly it's been well documented to decrease the severity of the disease. So the more people you have vaccinated, even if you don't have quote unquote herd immunity, what we will see is really a decrease in pressure on our healthcare systems, as even the people that do get the disease are likely to get it in a less severe form.
Thanks. So now to Umesh Verma. I sort of asked this question a different way. I'll rephrase it a little bit as we talk about technology, and what impact do you see the pandemic and this switch to an online economy impacting businesses going forward? Where do they fit this into their bottom line as they maybe spend more money on certain digital assets and less maybe on real estate? Umesh may be muted. And so maybe I ask that question to Jesse as he looks at the economic output where do you see the digital economy essentially taking the place of some other sectors, especially in West Houston?
Well, obviously the biggest one is office space, where, you know, if you're no one wants to go, particularly in Houston, no one wants to interact, in the case of Houston, with the 610 loop any more than they absolutely have to, or any of the major highways near there. So that's something that's generally wants to be avoided. So now that we've invested this human and intellectual capital into learning how to do online, everyone is going to take advantage of that. They're going to say, you know what? Yes, we acknowledge the in-person interactions, the chatting around the water cooler, the productivity that comes from person-to-person interaction. We want to make sure that we can take full advantage of that, but we're going to have more flexibility. And when people come in, flexibility in terms of what days of the week, maybe not everybody's going to come in every day of the week. It's going to certainly supplant a lot of business travel. You know, I'm just thinking my own example. The Dallas Fed, we used to shuttle people back and forth between the different district banks for all kinds of different meetings. And many of those meetings now will be virtual going forward. And so there's going to be a shift in demand away from business travel. There's going to be a shift in demand away from office. Now, in the case of offices, you know, if I have more employees working remote, there might also be a change in how they demand office space. There might be say, well, we're going to need more common spaces. We're going to need, maybe we'll spend a little bit more amenities to get people to come in on those days. We'll have more gyms. Maybe we'll have more shared spaces. You know, maybe there's more flexibility for childcare services or something, because we have these now these more dynamic relationships with the employees. But it's going to be interesting to watch. But it certainly is going to change those dynamics. And from an energy standpoint, commuting is and you know, it's a bit of a perverse, you know, incentive for Houstonians, because we love lots of oil consumption historically as a city. Although, you know, maybe we don't all necessarily love it, but you know, we generally like to see, you know, that oil revenue, the energy industry doing relatively well. But you know, the industry really also likes it when people are stuck on parked in I-45 burning gas and not going anywhere. And with more flexible times, that could put downward pressure on congestion relative to what we might have expected in prior to this going forward, which would slow the previously projected paces of growing energy demand over the next several years.
So I'll get back to Umesh in a minute. I saw him there typing away on his keyboard, but while you're talking about property, I thought it might be a good place to ask about interest rates. They're historically low. And so either you, Jesse, or Frank, you could talk about this. What benefit is there in all of this to business? What downside is there as we look forward with low interest rates that encourage spending?
Jesse, do you want to start, or?
You go ahead, Frank. I'm in blackout, so I'm going to try to think about something I can say without getting fired.
Okay, well, you can correct me. Well, look, I think, Tom, that you know, clearly low interest rates are incredibly attractive, and I think that that's one of the big drivers for the increase in the demand for residential mortgages. People are quite simply looking at this as an opportunity to lock in. And on the business side, that's the case as well, with some of the demand for loans. For instance, if you look at refinancing owner occupied, and if it's something that businesses are faced with an opportunity to maybe expand or try and build for future expansion, and they have the capacity, they have the cash flow to be able to do it, then they're going to go ahead and do it. Now, I think that, you know, we have the on the one hand, we have the low interest rates, but we have the uncertainty of not knowing how bad, how long this will end up being. So, you know, it changes every day. We see good signs on the side of the vaccines, and we get encouraged about that. And you know, it's just a matter of trying to read the tea leaves. What I think is also interesting is that our customers have not been affected the same way. You know, we have some companies that have been dealt a body blow, and they're in trouble, and they're just struggling to stay afloat. And And, maybe refinancing something is a good way of helping their cash flow. But then we have some others that have been sitting on cash. They're looking for opportunistic purchases and expansion, and then they're going to continue to move. And so I think that yes, it does create a very good incentive and an opportunity for companies to acquire and to expand. But there is the question of the uncertainty. So it's those that have been able to kind of deal with the second question that are going to be able to move forward.
So I'll go back to Umesh and the question that I had earlier about the shift to this to doing work online and how companies financially plan for this when they look at their ledger as opposed to spending money elsewhere. How much are you finding that this is sort of the new way of doing business, just sped up by the pandemic, if it was headed there already?
Right, absolutely. So it was headed there originally, but it was kind of at a very steady pace. And what the pandemic's done is really pushed us all to think about digital delivery of products and services. And so that digital delivery of products and services has also increased the cloud adoption. And so software as a service applications, cloud services instead of on-prem services. So the big shift there from a financial perspective is just the financial treatment of these services, where traditionally some of this, your infrastructure costs were depreciated, whereas now these are OPEX instead of CAPEX costs. So that's going to be a major shift in how many companies are going to have to think about this especially going from brick and mortar to more digital delivery of services on cloud platforms.
And so your advice to some of the business owners or executives listening today about how they move forward to make sure that they're doing the best thing for their company financially as they navigate this rapidly changing digital environment?
Right. So, talk with your accountants, talk with your attorneys, make sure that you're structuring your agreements in a way that your receivables can actually be, because the receivables also are going to change and your payables structure is going to change. And so the way you report your financial statements to the banks, and that affects your credit lines, that's going to change. So get some good advice. Excellent
news, or excellent advice, rather. Thank you. Jesse, anything that you can say that won't get you fired?
Well, so, interest rates have been low. The Fed, we've been very accommodative over the past several months. And certainly as economic conditions are evolving, if need be, the Fed will change its stance. But with low interest rates, one of the things that is going on is that it is rearranging, the yields on some investments versus other investments. And so you've seen money flow into, say, equities and other types of assets as companies sort of take advantage of this different thing. And so, to the extent that this is going on, that's helped a company, particularly for public companies, then, that's helped those businesses, at least in terms of their equity performance. But one of the things that we always hear about is when we talk about low interest rates is that they're very helpful if you have a capital investment project that the economics look good anyway. In a lot of cases, particularly, the industries that I focus on are all oil and gas. The interest rates aren't not really what's determining their capital investments. It's the underlying economics, and at the margin they're responding to this interest rate environment slightly. It's not really changing the business plan, it's just changing the cash flow for the business plans that they're executing. Now, I do have to say about the banking industry, one thing that we've been hearing about throughout this period is the banks have been very good about working with their customers, working with, but even in the oil and gas sector, where you might say, there's a lot of headlines about how out of favor it is, working with them on their covenants and on their payments and working and workouts and trying to get these work through this very difficult period. So it's been an interesting time.
So, Dr. Eller, I know that the medical community, hospitals, big part of West Houston's economy. How is all of this affecting that sector?
It's having several impacts, really. I think like any other industry that undergoes significant stress, it really starts to, cull the cream towards the top. We have really an outstanding group of healthcare entities across West Houston and outstanding leaders at those. And what we've really seen is sort of a honing of that. It's not really a culling of healthcare institutions, but really it's called on those leaders to, up their game in terms of care delivery. But it's put significant strain on the people that are delivering that care. And, we're starting to see that, and those impacts will not be seen for a year or two to come, where we see increased burnout. We do know that there's increased demand for healthcare. There's going to continue to be. So, the business itself overall remains strong, but, we took a significant hit during the early part of the pandemic when, elective medical care was shut down, and we're still seeing some of the residual from that, where patients are postponing care that they would otherwise be getting out of fear or concern. And, the volumes are down, across the non-COVID volumes are down across the board. I think, speaking for MD Anderson personally, one of the most significant impacts that we've seen has been on the availability of blood. And, that's probably something that I ought to mention to everyone on this call, for yourself, for your employees, and for your family and those in your circle of influence. I would encourage people, if they are able to donate blood. Believe it or not, MD Anderson transfuses about 1% of the United States blood supply every year. So 1 out of every 100 units actually is delivered by MD Anderson. So we really need a robust supply of blood, and we're dependent upon that. Our patients are dependent on that. So I would call on folks, if you can, please go and donate blood. That's definitely something that the community could do to help us.
So I do want to ask each of you, before we wrap up this discussion, I think it's important that you convey something that I didn't think to ask you to the people watching today. And so, Dr. Ehlers, we'll start with you. What do you think, other than giving blood, what do you think is something that those in attendance need to think about in the year ahead?
I would say from a healthcare perspective, it really is focused squarely around COVID. And that is, despite the fatigue that we all feel over having to wear masks, social distancing, hand washing, that those things really remain a key part of our strategy to decrease the prevalence of the disease. So I would encourage folks, wear your mask, please wash your hands. And that's something that oftentimes we just sort of roll off our tongues, but don't really focus on. Really a good solid 20 second washing of your hands in between, any sort of physical contact. It's really very helpful. And I would encourage folks, as the vaccine becomes available to you, please do take it. We have seen variable uptake and concern about it, and it is safe. I've already received it, and I'm fine, and I'm here. So I would encourage folks, get the vaccine as soon as you are able. Wait patiently in line. The vaccine will get to you. And as soon as we do that, we can start to go back to whatever sort of normal world we had pre-COVID.
Thank you. Umesh, your thoughts?
Yeah, sure. So, my business is in cybersecurity and technology and digital delivery of products and services. And so from a cybersecurity perspective, I would say that the biggest risk right now, as people transition totally or a large part of their businesses into digital delivery, is being aware of the vectors of risk. And the biggest vector of risk right now is through malware. And malware comes in really the two big pieces of malware, ransomware, and the effect is third-party risk. So malware, for the listeners, is really a piece of malicious code that gets downloaded onto your laptop or your workstation or your device and then it allows for nefarious activity to be performed on your behalf. Ransomware is really one of the big drivers right now, where this malicious software comes in and it zips up your drives, and then you get a little screen that says, this is how you get your data back, pay X amount of money, either probably through some kind of cryptocurrency transaction. And that key gives you the ability to unzip your drives and get your data back. Now, ransomware perpetrators are increasing in sophistication, and now what they've done is added the ability to not only encrypt your drives, but to actually export or exfiltrate your data. And then you are stuck with probably reputational loss issues if that data gets out and it's sensitive enough, and then you've got breach fines, and you can really go out of business just on the breach notification laws and the breach fines. So be aware of ransomware. And then the other part that has really become evident here in the last couple of months is this third-party risk issue, where the example is the SolarWinds breach, which was a nation-state-sponsored hack, where this nation-state infiltrated the software distribution system for SolarWinds and replaced pieces of their software with backdoors for intruders to gain access to. And then they released this software through the distribution channels to a large majority of SolarWinds customers, and about 80,000 customers worldwide were affected. And also this has infected hundreds of government agencies, including the most famous address on Pennsylvania Avenue. And so that really kind of lights up the idea about that, third-party risk comes in many forms. And so your vendors can be a proxy to any intruder into your system, as well as service providers like accountants, lawyers, IT service providers, consultants, even your customers. And the vector that most of these ransomware malware attackers use is phishing. So phishing attack comes in through an email. It's typically around current events with highly provocative headlines such as coronavirus, it's death toll, vaccine related, election related, make money quick related, magic diets to lose weight gained during COVID, and exercise, get rid of your weight without exercising and eat whatever you want. So be careful of that clickbait email, because that's what gets you into trouble, and then you download a malicious software. And then the emerging threat is the remote worker. And the remote worker is a real problem for many companies with less than 1,000 employees, because over 50% of that market does not mandate the use of a virtual private network or a VPN to connect to the corporate network. And more than 70% use their home Wi-Fi while sharing it with kids and spouses and guests. No segmentation of their Wi-Fi systems. And about 2/3 of those remote workers have never changed the password for their Wi-Fi that the internet service provider created when they install the internet services in their home. And then many of the technicians that come over set up the same password for the Wi-Fi routers across many of their installations. And then more than 2/3 of these home workers have not set up two-factor or multi-factor authentication. So what that means is that on a personal level, they are exposing their bank accounts, retirement accounts, investment accounts, tax, utility, loyalty, rideshare, hotel accounts, so on and so forth. And on a corporate level, that means that these remote workers are now susceptible to an intruder coming in and piggybacking on their credentials and then gaining access to the corporate network. So there's, I would say that there is a lot to really kind of think of in this space, and digital delivery and technology is now a sophisticated business. And so definitely get a security assessment, get your vulnerability assessments done, have a plan for remediation. Over 45% don't have any monitoring of user activity in their networks. Let alone users, they don't even monitor administrators on their networks. So there's a lot here, and security and digital delivery is now a sophisticated business, and get expert help.
I almost wish I hadn't asked that question. So what do you suggest to businesses now that there are these additional threats where employees are not within their secured networks at their workstations on property, but rather away from work? This is not the time necessarily that a lot of companies have much extra money to spend on it, but it certainly would be worthy of the investment could they do it.
Yeah, and the other side of it is that many of the things that I'm talking about, like you practice good cyber hygiene. These are settings and policies that come within your operating system. It's a matter of actually turning these on. Now, some of these cause extra bureaucracy and get in the way of productivity, and they're viewed as hurdles, whereas actually it's better security. Get your security controls in order. Invest in regular security awareness training for not only your employees, but also your vendors. Insist that they turn on multi-factor authentication. There's no extra charge for that. It's already there. It's a capability. Turn it on. Encrypt your emails. There's no extra charge for that. That comes part and parcel of Office 365. Vet your vendors and your service providers for their security processes, procedures, and certification. There is a cost of time, but you're already paying for your overhead to do that, so put that process in place. Monitor your admins and user actions. That's also part and parcel of the systems. However, there is to really make use of that data, you need to be able to cull it down. It creates a lot of data, so you do have an extra cost there. But so the most of the stuff is actually there in your existing operating systems. You need to turn it on and begin to use it. The cost comes in the people side and the resource side to be able to allocate resources to actually protect yourself.
Thank you. That was good. We appreciate it. Frank, your final thoughts.
Okay, well, kind of piggybacking on Umesh's comments of behaviors that don't necessarily bring on extra cost. I think it's a good time to make sure, especially for small businesses, to make sure that their accounting is accurate and that they're confident in that, because if they do need to come to the bank for some financing or something, they don't want to really have to be sorting out things and correcting entries and that sort of stuff. So I think that making sure that is in order is important. The other thing that I think is important at this time is that there are a whole lot of government programs. I mean, we know that the PPP is going into another phase right now, but there are other programs. And, the SBA has a pile of programs that can be accessed. And, even businesses that hadn't previously thought of that should well give them a thought. And so they can come into the bank, they can talk about it, they can look it up on the SBA's website. It has a very comprehensive guide, and there are YouTube videos and all sorts of things. And I guess the point is that there are a lot of other resources, and we're there to help. And as are all these organizations. For companies that export here in Houston, Ex-Im Bank is huge and has some terrific programs, among them the Working Capital Guarantee Program. So there are a lot of programs out there that maybe businesses haven't thought about, but this could just be the right time.
Good, Frank, thank you. And Jesse, we'll wrap with you and ask you your final thoughts with anything that won't force you to leave your job.
We don't want him
well,
fired.
I appreciate that. I think there's so much to be said about the uncertainties that we have coming forward with the new administration, with the virus mounting, with everything. But I'm going to end. I think my main thought that I want to end with is the thought that Dr. Ehlers began with, and that is that this virus is in the driver's seat of our economy, and if we could all make sure that we're wearing our masks, that we're keeping social distance, that we're washing our hands, and not just when we go to our stores, but when we interact in many times with some of our neighbors, or sometimes even if in our case we have to be careful with play dates, and you're meeting with you've got siblings and older siblings and parents and grandparents that might be around, that you've got a COVID bubble. I'm sure we all do. That for a friend, where we try to keep our sanity in this period with friends and family, but getting the virus under control is the path to economic recovery for all of our businesses. and back to stability for many of our most severely affected households. So that's the thought I'll end with is do your best to prevent catching or spreading the virus at all.
Thank you, Jesse. And thanks to all of the panelists for sharing your insight with us on this Friday. On behalf of Amerant Bank, I'd like to thank all of you for attending the event. Be sure to join us in 2022 for the next West Houston Outlook conversation on the future of West Houston. Hopefully, we will all be doing this in person next year and not sitting on our computers hoping that we don't get hacked by malware. And remember, all of the connections you made today during the virtual event remain online for the next 6 months. Again, thanks. Be safe and healthy, everybody, and we'll see you later.
Thank you.
Thanks, Tom.